support in silver is around the low 70s, but it's been very volatile. There's been several days, all of a sudden they whack silver down $10, $12. You got to be a little bit more careful in where you're buying it. But I think if you're buying it in the low 70s, I think you're pretty good. But if you end up buying it at 85, 90, you better be prepared for it to come down. If you're buying it at, 90, you should not buy it all. Just buy some and maybe you get a pullback. When people come on and they say, $7,000, $8,000 gold, whatever, they don't get laughed at. My strategy is doing great. People who invested in gold stocks now over the last 10 years have done better than the S&P. If the Dow rises, then, gold's got to be higher than 10,000. If Trump is right and the Dow goes to 100,000, well, then gold's got to go to 20,000 to get 5-to-1. I think we're going to be at least 5-to-1, but I think it's going to be a lot lower. I think we're going to get close to 1-to-1. For physical gold, 5,000 is about the floor now. Whenever it goes below 5,000, it doesn't get much below 4,900. And it doesn't stay there for more than a day.
Gold is still hovering at about 5,000 US dollars per ounce. I'm curious, because you've posted these clips of you've been on mainstream media would criticize you for these gold targets, or you promoting gold or touting gold or whatnot, and it seems to be like a major shift. I've still been seeing some articles that kind of attack gold in some ways, but it seems like the mainstream media is starting to hop on this train as well when gold's at 5,000 instead of when it was at 1,600.
Yeah, when I was making $5,000 gold predictions, back in 2011, 12, 13, when gold was like 1,200, 1,500, not only were they making fun of me, but they were accusing me of, just trying to scare people into buying gold, that I was just a gold salesman and I didn't even believe it myself, and that I should, really be ashamed of myself because I'm telling people to buy gold, right, when they could be buying the stock market, and they're going to lose money because they're missing out on the stock market.
Wall Street's tone changed only after the price did. As Peter Schiff reminds us here, the ridicule came when gold was near $1,200 in 2011 to 2013, not at $5,000. That's a 300% move, and suddenly the same media that dismissed it now frames it as obvious. The S&P 500 was the only game in town back then, especially during QE3 and zero-rate policy, yet real purchasing power erosion was building beneath the surface. This isn't about ego. It's about how narrative follows price, not fundamentals. What Peter Schiff implies next goes deeper than media bias. It questions how early conviction gets punished before it gets validated.
When I never told people to exclusively own gold, I just said own some gold, right? I said don't not own it, it's going to go up. And as it happens, it's done better than the stock market. So to the extent that somebody didn't buy the U.S. stock market and they bought gold instead, they're better off. But, they never used to attack people for, who were in the stock market, who managed, they were brokers or asset managers, and they would come on and they would talk their book, and nobody ever attacked them. It's like, hey, come on, you're just saying that because that's your business, right? You're just pumping stocks because you want people to buy. They all of the criticism was reserved for me because I was saying buy gold, something they knew nothing about. And they didn't care about it. Well, clearly they should have, because gold has done better than the stock market for 25 years, 26 years. And there's a reason for that. I knew why the price of gold was going to go up. It wasn't just some random thing. And I wasn't telling people to buy gold because I sold gold.
Diversification was framed as extremism. And that's the real disconnect. Peter Schiff clarifies he never argued for 100% gold, only allocation. A core portfolio principle taught in every CFA program. Yet during the 2010 to 2021 liquidity boom, asset managers promoting equities faced no scrutiny, even as forward PEs climbed above 22x. Gold's long-term outperformance over certain multi-decade stretches reflects currency debasement cycles, not speculation. The critique wasn't about conflict of interest. It was about discomfort with an asset outside the mainstream playbook. Peter Schiff is challenging a bias in financial culture, and that bias shapes how retail investors allocate risk.
I got into the gold business because I thought people should own it. And I saw other companies were overcharging people for gold. And so I set up my own company, Schiff Gold, so that people wouldn't get ripped off when they bought gold. But years before I was selling gold, I was still telling people to buy it because I thought they needed to own it. I was still, stockbroker, but I thought people needed to own gold. But yeah, now I notice that when people come on and they say, oh, $7,000, $8,000 gold, whatever, I mean, yeah, they don't get laughed at. They don't get made fun of. And they never made fun of the Bitcoin guys. I mean, I see these Bitcoin guys who not only own Bitcoin, but their entire livelihood is Bitcoin. They're in a Bitcoin company. And they go on, they say, Bitcoin's going to 200,000. Bitcoin's going to 1 million. And nobody ever questions their sincerity. No one says, oh, come on, you're just saying that because you have a Bitcoin company, right? No, nobody ever questions their objectivity the way they question mine. Oh, and the way they deal with it now, like on a CNBC, I haven't been on in over 10 years, right? They stopped having me on because of, my forecast.
Notice which forecasts get labeled visionary and which get labeled self-serving. Peter Schiff highlights a media double standard. Bitcoin executives projecting $200,000 targets face applause, while gold advocates once faced exclusion. Since 2017, Bitcoin has seen 70% drawdowns multiple times, yet optimism remains celebrated. Meanwhile, gold's volatility has been materially lower over decades. Media gatekeeping often aligns with momentum and advertising narratives, not risk-adjusted reality. That absence from platforms like CNBC speaks less about accuracy and more about narrative control. Peter Schiff is exposing not just bias, but who decides which asset classes are allowed optimism.
Meanwhile, my strategy is doing great. People who invested in gold stocks now over the last 10 years have done better than the S&P. Mm-hmm. I've had a big weighting in gold and silver stocks, and now over a 10-year time frame. Now, that wasn't true 2 years ago. We were way behind 2 years ago. But in the last 2 years, we caught up and then passed them. And I think that this trend is going to continue. So I think over the next several years, people who are following a mainstream U.S.-focused approach are going to fall further and further behind people who are following my strategy, which is gold and silver stocks, physical precious metals, but also non-U.S. stocks, foreign stocks, emerging markets, resource-type investments. This is what's going to be making money for many, many years to come. The stuff that worked in the past isn't going to work and is not working in the present, and it's going to work even worse in the future.
Yeah, I'm curious if you've received any calls or emails from some folks from back in the day, like, hey Peter, you were right.
Leadership shifts slowly, then all at once. Peter Schiff argues that over a 10-year window, gold and silver equities have now overtaken the S&P, especially after the 2022 to 2025 inflation cycle. Market leadership rotation is common. Think tech dominance post-2009 versus commodities in the early 2000s. US-centric portfolios benefited from dollar strength and mega-cap concentration, but that concentration risk is historically fragile. Emerging markets and resource sectors often outperform during late-cycle dollar weakness and rising debt stress. Peter Schiff is signaling that the next decade may reward diversification far more than blind loyalty to US indexes.
Just saying hey.
Well, they still want to say, well, I was too early, right? I mean, I was predicting, I didn't say it was going to take 12 years to get to 5,000, which is true, right? I didn't think it would take this long. In hindsight, yeah, I mean, I'm surprised that it took until, 2026 for gold to get to 5,000. But because it took so long, it isn't going to stop at 5,000. I now have a much higher target because when I was predicting $5,000 gold in 2011, 2012, I had assumed that other things would have happened to have gotten the price up that high, which haven't happened yet. We haven't really had a dollar crisis. We haven't had a sovereign debt crisis. So that's still in our future. So it's still going to happen, but it just means when it does, gold's going to be a lot higher than 5,000.
Mm-hmm. So you said,
we kicked the can down the road for a lot longer than I thought back then.
Yeah. So you said you have a higher target. So just curious, and what are you thinking for gold in this bull cycle?
Timing is the part of macro forecasts that humbles even the right thesis. As Peter Schiff points out here, gold reaching $5,000 without a formal dollar or sovereign debt crisis suggests structural pressure is building quietly beneath the surface. US federal debt has surpassed $34 trillion, and interest costs are now one of the largest budget line items. That alone reshapes long-term currency risk. If the crisis hasn't officially arrived yet, but gold has still quadrupled from 2011 levels, investors should question what happens when stress becomes visible. Peter Schiff is hinting that the next move may not require panic, just math catching up.
Well, I don't know where it's going to peak out. I mean, 15,000, 20,000. I mean, I think 10,000 is pretty much a lock over the next few years. But, it could go a lot higher. It just depends on how the scenario plays out with the dollar and the bond market. But, I would not be surprised. We're 10 ounces of gold. As I said, the Dow is worth 10 ounces of gold. It was worth over 40 25 years ago. I think it's pretty much almost a sure thing that we're going to go down to 5. The record low for the Dow priced in gold is around 1-to-1. And that happened twice, in 1932 and 1980. Now, if the Dow and gold are 1-to-1, the Dow's 50,000. I mean, if the Dow just stays here, then gold goes to 50,000, right? Now, the Dow could crash. The Dow could go to 20,000 and gold can go to 20,000. That's still 1-to-1. But if we just get to 5-to-1, which I think is a very realistic number, if the Dow stays where it is at 50,000, gold needs to go to 10,000. And now it's 5-to-1. But, if the Dow rises, then, gold's got to be higher than 10,000 to get, if Trump is right, and the Dow goes to 100,000, well, then gold's got to go to 20,000 to get 5-to-1.
The Dow-to-gold ratio is a quieter signal than CNBC tickers, but historically more revealing. Peter Schiff frames this in ratio terms, not price hype, and that matters. In 1932 and 1980, the Dow-to-gold ratio fell near 1-to-1 during systemic stress. Today, near 10-to-1, equities remain historically expensive relative to hard assets. If earnings compress during a recession, while rates stay elevated, the ratio can fall through equity declines, gold appreciation, or both. That's not drama, it's reversion math. Peter Schiff is suggesting investors watch valuation in ounces, not just dollars.
Yeah.
But I think we're going to be at least 5-to-1, but I think it's going to be a lot lower. I think we're going to get close to 1-to-1, maybe not exactly, but maybe below 2-to-1, before it bottoms out. And my thinking would be, if you could buy the Dow Jones for less than 2 ounces of gold, you should do it. You're probably getting a really good deal.
Yeah.
But right now, at 10 ounces of gold, I still think the U.S. stock market's overpriced.
Yeah. Okay. Got it. So, what should investors be thinking about? So obviously gold going higher. Some investors are thinking of gold in terms of, they just want the price to go higher. But really it's money itself, right? The physical gold is money itself, and it preserves your purchasing power. And so, and obviously the gold stocks are a different way to get leverage if you're wanting to make a bet on the gold price going higher and cashing it out for dollars. But I think about the recent washout, which I don't know if that was a combination of factors. I assume it's a combination of factors.
Most investors measure wealth in dollars. Few measure it in purchasing power. Peter Schiff shifts the focus from speculation to preservation, arguing that gold's role is monetary insurance, not just upside. At roughly 10 ounces per Dow unit, equities remain richly valued compared to long-term historical troughs near 1 to 2 ounces. If inflation persists above the Fed's 2% target or earnings stall in the next cycle, nominal gains may hide real losses. Physical gold and mining equities behave differently. One preserves, the other amplifies. Peter Schiff is drawing a line between trading momentum and protecting generational capital.
I don't know if it was the paper markets or what, but we have more new investors coming into the space, and they see gold at 5,600, 5,500. They buy in, gold crashes down 4,900. People typically get weekends get washed out of that. And so what should investors like that buy physical gold be thinking about when they're buying that asset?
Well, I look for physical gold. I think that 5,000 is about the floor now. I mean, whenever it goes below 5,000, it doesn't get much below 4,900, and it doesn't stay there for more than a day. So I think that's really the new support level for gold. So people should be buying gold here, not thinking they're buying the high, but they're buying the new floor. Right? Silver, a lot more volatile. I'd say the support in silver is around the low 70s, but it's been very volatile. And there's been several days, all of a sudden they whack silver down $10, $12. So, you got to be a little bit more careful in where you're buying it. But
volatility tests conviction more than fundamentals ever will. As Peter Schiff notes here, sharp pullbacks from $5,600 to $4,900 can shake out new entrants, even when broader macro trends remain intact. A 10 to 12% correction in a secular bull market is historically normal. Gold saw similar swings during the 2009 to 2011 run. Support levels matter, but investor behavior matters more. Weak hands amplify short-term moves. Silver's $10 intraday drops reflect thinner liquidity and speculative flows, not necessarily broken fundamentals. Peter Schiff is reminding investors that discipline, not emotion, determines long-term outcomes.
I think if you're buying it in the low 70s, I think you're pretty good. But if you end up buying it at 85, 90, you better be prepared for it to come down. And if you're buying it at 90, you should not buy it all. Just buy some and maybe you get a pullback. But I don't know how long this volatility is going to last before silver just goes and makes a new high. But the high was 121. So even if you're buying it at 90, you're still buying it $30 below the high, right? So you're not buying that. You got a pretty good correction here already. Now the mining stocks are a whole different animal. I think they're ridiculously cheap. And the reason for that is, yes, they've gone up. I mean, they've tripled, but the price of gold and silver have tripled. The stocks should have gone up a lot more given the leverage they have. And the reason they haven't is because investors are still so skeptical of this rally. They've been skeptical the entire time. So they're not willing to reprice the mining companies as if gold and silver are going to stay at these prices.
The real story isn't silver's price, it's the market's refusal to believe it. Peter Schiff is acknowledging volatility risk near $90, but he's also pointing out a psychological ceiling. Investors still expect mean reversion. Historically, silver has experienced 30 to 40% pullbacks even inside bull markets, so that caution is grounded in data. Yet mining equities typically carry 2 to 3x earnings leverage to metal prices, and despite metals tripling, many miners haven't reflected that operating torque. That disconnect suggests skepticism is suppressing multiples, not fundamentals. And what Peter Schiff implies next challenges whether this skepticism is creating one of the most mispriced segments in the equity market.
They expect the prices to fall, and so they're not, ratcheting up their earnings estimates for the outer years because they expect that by then gold and silver prices will be down. But not only are they wrong to believe that the gold and silver prices are going to fall, they're wrong not to understand they're going to keep rising. So the earnings estimates are way off on these companies. And that's why they're actually cheaper now than they were a couple of years ago before they tripled. Now, to me, I bought them all back then. I was buying them hand over fist because I knew the gold and silver price were going to go up. I knew the market was wrong. But the people who were wrong a couple of years ago, they're still wrong. Even though the prices went up, they don't believe it's sustainable. So they're wrong again. So I'm not buying a lot of gold and silver stocks right now myself because they're already such an overwhelming portion of my portfolio that I've been buying more energy names.
Forward earnings models often tell you more about analyst bias than business reality. Peter Schiff is arguing that consensus estimates assume falling metal prices, which compresses long-term EPS projections. Analysts frequently anchor to prior cycle averages. After 2011's peak, many miners traded at 20x earnings before collapsing when gold fell 45%. That scar still shapes valuation models today. If metals remain elevated, current PE ratios, some in single digits, may reflect artificially depressed forward assumptions. Meanwhile, his shift toward energy signals portfolio concentration risk management, not wavering conviction. Next, Peter Schiff pivots to diversification logic that reveals how position sizing matters just as much as conviction.
I've been buying more emerging markets, stuff like that, just because my gold and silver portfolio is now such a large part of my overall portfolio, given the gains, right? Because I was 50, they were 50% of my portfolio before they went up. Right? Mm-hmm. So, but for people who are just coming on board, if they don't own any gold and silver stocks at all, they're the first stocks I'm saying you got to buy. I mean, they're a slam dunk as far as I'm concerned. But yeah, and I manage a gold fund too, which I think is a great opportunity because our gold fund has underperformed the indexes because we have about a third in these small, real junior miners, which have not moved nearly as much as the bigger companies, but which I think have the potential to move up a lot more as the bull market matures and investors have more confidence in the longevity. So, it's great to be buying my gold fund. The symbol, if you want, you can get it no load at any discount broker. It's EPGIX.
When a position grows to 50% of a portfolio, discipline becomes more important than enthusiasm. Peter Schiff admits his metals exposure expanded through gains, which is textbook concentration drift. For new investors, he calls miners a slam dunk, but history shows junior miners can swing 50% plus in a year due to financing risk and operational setbacks. Smaller cap miners historically outperform late in commodity cycles, yet they also lag early when confidence is fragile. Underperformance today may reflect liquidity preference for larger producers, not broken fundamentals. What Peter Schiff suggests next forces investors to consider whether patience in juniors could be the asymmetric play of this cycle.
It's the Europe Pacific Gold Fund, EPGIX, or you can go to Europac.com, talk to my advisors. We also have separately managed accounts where we have strategies that are in gold and silver mining stocks. Now we also have more broad strategies, foreign dividend paying stocks and things like that. But we do have a core strategy that is focused on mining, and obviously, it's had great returns last year, and it's having great returns again this year.
I'm curious. Did you tune into any of the Agnico Eagle? I think they had the earnings call or something. But
no, I noticed that it beat earnings estimates, and obviously AEM's earnings are substantially higher than they were a year ago. So you have incredible growth, but the stock is only up 5% today after being down more than that yesterday. It's not even at a 52-week high. It's about $10 below the 52-week high. And I think that AEM...
Strong earnings without a strong stock reaction is usually a message, not a mistake. Peter Schiff highlights AEM beating estimates with substantially higher year-over-year earnings. Yet the stock sits below its 52-week high and barely moved 5%. In efficient markets, earnings surprises often trigger sustained re-rating, unless investors doubt sustainability. That hesitation mirrors broader miner sentiment. Even with revenue growth accelerating alongside gold, multiples remain compressed. It suggests institutions are trading headlines, not committing capital long-term. And what Peter Schiff implies next about valuation premiums may reveal whether this hesitation is opportunity or warning.
Which has typically traded at a premium to its peers because it's probably the best managed major gold company out there. The premium that it's trading at now is about a record low. So investors are not paying up to own AEM. So it's actually a pretty good time to be buying it because it's normally a lot more expensive relative to its peers. But I think that, their earnings are going to keep on growing because gold's not going to stop rising at 5,000. It's going to 6,000. It's going to 7,000. It's going higher. And so their earnings are going to keep on growing. That's not the case. A lot of other companies, that have much higher valuations don't have that kind of earnings growth that you've got in the gold mining space.
When a quality company trades at a shrinking premium, markets are pricing in disbelief. Peter Schiff argues AEM's valuation gap versus peers is near record lows, despite historically commanding a premium for operational execution. In equity markets, premium compression often signals either cyclical fear or skepticism about forward growth. If gold sustains higher levels, minor free cash flow margins could expand meaningfully, yet broader equities trade at 20x plus forward earnings without comparable growth visibility. The contrast exposes where optimism is concentrated and where it isn't.